together for a company, a fictional company, that I'm going to call Nairobi Trading Inc. We are going to do both the journal entries, the debits and credits, but also build up the balance sheet. So if you haven't downloaded the spreadsheet already, please do and follow with me. You can always speed me up or slow me down. Okay, so let's get started. We're going to record 5 separate transactions. The first transaction is we have issued common shares of 500. So let's start with the journal entry. I always like to start with cash. And if we say what is cash, cash is an asset, and when we increase an asset, that is a debit. So we know we're going to debit cash 500. Now, the nice thing about a journal entry is we know it has to balance. So we know that the other entry has to be a credit, but we also know that when we increase equity or increase common shares, that is a credit. So we are going to credit common shares 500. The journal entry balances. Now let's move down to the balance sheet and update the balance sheet with this transaction. Okay, so here we have the balance sheet, and we've said cash increases. I'm going to use an equal sign. You'll see why later, so that I can record each transaction and have a trail of all the transactions if I need to figure out something that might not go right or wrong. Okay, so there's the cash, it's 500, but we also know we have shares that are 500. And our balance sheet balances, you probably can see here at the bottom, there's a nice little check. So you can see if it doesn't balance, what the difference is, and investigate where that difference might be. Okay, that's the first transaction. Let's go to the second transaction. We bought equipment for 300 with cash. So here we have equipment, which is an asset going up, and we have cash that's an asset going down. So let's start with cash again. Recall that when we decrease an asset, it's a credit. So we're going to put 300 there, but then we're increasing an asset, which in this case is property, plant, and equipment, and we put 300 there. Our journal entry is complete. Our debits equal our credits, and now let's move to the balance sheet. Okay, so we are going to take 300 out of cash, but we're going to add 300 in property, plant, and equipment. The balance sheet balances, we can move to the third transaction. Our third transaction is we bought inventory of 100. Now, 80 of this was with cash, and the remainder is outstanding at the balance sheet date. In other words, we owe our suppliers 20. Now, we know that when we owe something, that's a liability. And when we owe something to our vendors or suppliers, we call that accounts payable. So let's do this transaction. We're going to start with cash. Now we are decreasing an asset, which is cash, so that's going to be a credit. We're buying inventory, so we're increasing an asset, so that's a debit of 100. And we have to deal with that 20 that we owe to our suppliers. Remember, that's a liability. We're increasing a liability, so we know that's a credit. And we also know it has to be a credit for the journal entry to balance, and that's accounts payable. Now let's put that on the balance sheet. So we're going to start with cash. And recall that we have paid for 80 of the inventory, so we're going to go minus 80. But we also have our inventory going up, and that is at 100. Now, you can see we're out by 20 if you look at the bottom of the balance sheet, and that's, of course, because we haven't recorded what we owe to our suppliers or accounts payable. When we increase a liability, that's a credit. We put our accounts payable at 20 and our balance sheet balances. Now let's move to our fourth transaction. Our fourth transaction is going to involve a number of elements. So we sold 75% of the inventory for 120. Now 100 of this has been received in cash at the balance sheet date. But in other words, there's still 20 that is owed to us from our customers. Now, when our customers owe us something, that's an asset, and we call that accounts receivable. So now let's do this transaction. I'm just going to scroll down. Okay, so we have actually got cash increasing by 100. But recall that we sold 120, and 20 is owed from our customers as accounts receivable. That's increasing an asset, so we put our 20 there. We also have revenue increasing. Remember that revenue is in our equity, and when revenue increases, that's a credit. Now, our journal entry balances, but we haven't done the full transaction because we've recorded the revenue from selling the inventory, but not the expense of buying that inventory. So that's what we need to do next. So what's happened to our inventory? Well, we've sold 75%. So we're decreasing an asset. Remember, when we decrease an asset, that's a credit, and that's 75 or 75% of 100. But we also now have an expense. Recall that when we increase an expense, and that falls under equity, that is a debit. And that cost of sales or cost of goods sold is there, and our journal entry balances. Now, let's go back to the balance sheet and make sure we can update the balance sheet accordingly. So I'm going to start with our cash. Our cash goes up, recall, by 100, but also recall that we have some customers who haven't paid us yet, and that is 20 in accounts receivable. Next, what we have our revenues of 120. But now let's deal with the inventory. So we know there's a cost of sales, and we know that's 75, and that's an expense, so we're going to deduct it. But we also know that means our inventory, we're decreasing that asset also by 75. Our balance sheet balances, so we are good. Now let's go back up for one more transaction. Here we paid a cash operating expense of 15. So I'm going to start with the cash. What's happening with cash? Is it going up or down? It's going down, so we know cash is a credit, and that's 15. But it's also an expense. And recall that when we increase an expense, that's a debit. We also know that the journal entry has to balance. Now let's put that final entry on the balance sheet, and we will be done. So we have an other operating expense of 15, but we also paid for that with cash. So our cash is going to go down by 15. Our balance sheet balances, congratulations. Now it's your turn. Have a go at the next activity. Download the sheet and see if you can complete the balance sheet. And then once you've had a go, click Next, and I will debrief the activity with you. See you in a few moments. Okay, now let's go through this again with a separate fictional company that I'm calling Cairo Trading Inc. This time around, we're not going to do both the journal entries and the balance sheet. I'll talk to the journal entries, but we're going to go right to the balance sheet. So let's work through these 5 transactions together. Let me get my mouse and my cursor so we can work through those transactions. The first transaction is issued common shares of 300. Now, we're going to start with cash, and recall when we increase an asset, that's a debit, so we debit cash, or in other words, increasing cash by 300, but we're also increasing equity, which is a credit, and that's going to be equals 300 as well. The balance sheet balances, we're good. Now we bought equipment, which is an asset, for 200 with cash. So we have equipment as an asset going up, which is a debit, and we have cash, which is an asset going down, which is a credit. So what we're going to do here, so I'm going to start with cash again. I'm going to minus 200. But we also have to create an asset of 200 under property, plant, and equipment. Good, our balance sheet balances. So now let's move to transaction number 3. Here we bought inventory 50. 30 of this was paid in cash, but the remainder is outstanding at the balance sheet date. Now, in other words, 20 is still owed to our suppliers, and we call that liability accounts payable. So let's actually start with cash. So we're going to take 30 off because we're decreasing cash, so it's a credit. But we're also increasing inventory, so that would be a debit of 50. And we have 20 that is owed to our vendors or suppliers. So let's put the 20 there. Our total assets equals our total liabilities and equity, so we are good to go. Now, let's keep moving on. if we now actually sold 50% of inventory for 75, and 65 of this is being received in cash at the balance sheet date. So I'm going to start with cash, and I'm just going to scroll up so that it's very clear what's happening. So what we said is we actually made revenue of 75. So I'm going to start there. Of that revenue, we got 65 in cash. And we have 10 that's owed from our customers, and we call that accounts receivable. It's an asset. We're increasing that, so that would be a debit. So far, so good. Our balance sheet balances, but we also have to deal with the cost of the inventory. Remember, the inventory cost us 50, and we sold 50% of it. So we know our inventory is going to go down by half, or 25, but we're also going to have a cost of goods sold, or cost of sales expense, of 25. We call that increasing expense a debit, and decreasing assets as a credit. So our debits and credits still match, and our balance sheet balances. Now, there's just one more expense, and that is we paid a cash operating expense of 5. So let me go to cash first. I'm going to take off the 5. And then I'm also going to have to increase an expense, which is a debit. I'm going to go -5 there. Our balance sheet balances, the accounting equation holds, and congratulations, you've entered some more transactions and built a balance sheet from scratch.